The Federal Reserve Bank just cut interest rates for the first time since 2020, and they shocked Wall Street while doing it because Wall Street thought that the Federal Reserve Bank was going to cut interest rates by 0.25%, but instead the Fed came in more aggressive and cut interest rates by 0.5%. Why? Because Jerome Powell said that the inflation fight is over, and now the Fed can focus in on stimulating the economy, stimulating the job market, and hopefully avoiding a recession. Let me read you directly from what the Federal Reserve Bank published. They said, quote, "The committee," meaning the Federal Reserve Bank, "has gained greater confidence that inflation is moving sustainably towards 2% and judges that the risk to achieving its employment and inflation goals are roughly in balance." Meaning, now that inflation has come down, the Federal Reserve Bank is no longer worried about inflation, so now they can worry about stimulating the economy and stimulating the job market. Now, if you're one of the people that have been enjoying the interest that you've been getting from a high-yield savings account, I hate to be the bearer of bad news, but you can expect to receive an email saying that the interest rate you're getting paid is getting slashed because now the Federal Reserve Bank is also cutting interest rates. So, if you've been following the financial news or market briefs, you know that this rate cut was anticipated, but many people didn't anticipate a 0.5% cut. So what I want to do in this video is go over three things. Number one, how did we get to this point with interest rate cuts? Number two, what does this mean for mortgage rates, car loan rates, credit card debt, and everything in between? And number three, what does this mean for stock market investing and other asset prices? So if you're an investor, you definitely want to stay through this point as well. So starting with how did we get here? If you remember, back in 2019, the Federal Reserve Bank had interest rates at around 2.5%. That was after the 2008 crash when interest rates were near zero, and then after that, we worked to slowly raise interest rates to about 2.5% in 2019. Then in 2019, we had worries about an economic slowdown. We had worries about an economy cooling down, maybe a recession coming. So the Federal Reserve Bank proactively started cutting interest rates in 2019. We cut interest rates 3 times, so interest rates came down to 1.75%. And then, of course, came 2020. The pandemic. We already had low interest rates going into the pandemic. Now we had the pandemic. And that was when the Federal Reserve Bank cut interest rates to zero, because the Federal Reserve Bank cuts interest rates as a way to stimulate the economy, to stimulate spending, and the Federal Reserve Bank raises interest rates to cool an economy down and to cool down inflation. So in 2020 and 2021, we had 0% interest rates. But then came 2022, and we had an inflation problem. And to fight this inflation problem, the Federal Reserve Bank then began raising interest rates. Now, the Fed said that inflation was transitory, which we later learned was not true, but the Federal Reserve Bank began raising interest rates in 2022 through 2023, and they raised interest rates to 5.5%, which was the highest interest rates that we've seen by the Federal Reserve Bank in more than 2 decades. And that higher interest rate is bad news for people looking to get on more debt. So if you're looking to get a mortgage, higher interest rates are more expensive. If you're looking to get a new car loan, it's more expensive. If you have variable interest rate debt, like credit card debt, that makes your debt more expensive because you have to pay more money. Or if you're a business or a commercial landlord and you have readjusting debt, like many businesses and commercial landlords do today, the higher interest rates make your debt more expensive because when your debt goes to readjust, now you have to pay a higher interest rate on your debt. But the higher interest rates are also good for people that have cash, because the higher interest rates mean that you can actually get some sort of return on your money, because high-yield savings accounts are paying 5.25%, some even paying 5.5% in interest on your savings. Bonds are paying better returns, so people that were sitting on cash are getting better returns. But now here we are with the Federal Reserve Bank beginning to cut interest rates again because they believe that the inflation issue is no longer a problem, and now it's time to stimulate the economy. Now, of course, we go deeper into this in Market Briefs. Market Briefs is my free financial newsletter where every day my team is working to break down what's happening in the economy, the housing market, the stock market, crypto, and the global economy into a fun, witty, and easy-to-read newsletter. If you have not joined yet, it is completely free, and I got the link for you to join down in the description below, and I promise you are going to love it. Now, you might say, well, Jaspreet, how can you promise that? Well, if you don't love it, you can unsubscribe at any time because it's completely free. So where are we today in the state of our economy, inflation, and the job market? Well, inflation currently, the rate of inflation has come down to 2.5%. Remember, the Federal Reserve Bank wants to see 2% inflation, and the rate of inflation, the reported rate of inflation, the keyword is reported, but the reported rate of inflation is 2.5%. And unemployment has jumped up to 4.2%. And this is why the Federal Reserve Bank is now pivoting and they're changing their stance and they want to get more aggressive with interest rate cuts because they want to stimulate the economy. Now, some people are saying that this is politically motivated, that the Federal Reserve Bank is cutting interest rates aggressively to boost the stock market, to boost the economy before an election. And Jerome Powell did address this. And what he said is that the Federal Reserve Bank is not politically motivated and they're not swayed by any political factors. So take that for what it's worth, whether you believe it or not, but that's what he said. So the Federal Reserve Bank is now cutting interest rates because they believe that this is the time now to stimulate the economy because they don't believe that inflation is a concern anymore. Which brings us to the question of what does this mean for mortgage rates? What does this mean for credit card loans? What does this mean for credit card debt and car loans? Well, remember, we're talking about the federal funds rate. We're not talking about your mortgage rate or your credit card loan rate or your auto loan rate. The federal funds rate is the interest rate that banks pay one another when they borrow money from each other. This is set by the central bank, the Federal Reserve Bank. The rate that you pay, your mortgage loan rate and your car loan rate and your credit card rate, that is set by the bank. But if your bank pays a lower rate to borrow money, then they can ultimately pass those savings on to you. So there is a chance that you will see, or likely chance, that you're going to see mortgage rates and car loan rates and credit card debt rates also fall because now the Federal Reserve Bank has now begun cutting interest rates, so you can expect rates to fall. Now, the thing that you want to pay attention to with these lower rates is what is this going to do in terms of the economy and inflation? Because of course, lower rates are there to stimulate spending. Because if you can borrow money cheaper, you can go out and borrow more money and spend more money. You can buy more cars, a more expensive car. You can buy more homes or a more expensive home. You can buy more things on your credit card. But the concern I want you to think about is the Federal Reserve Bank raised interest rates aggressively to fight inflation. And the inflation problem is not gone. I mean, inflation is still around. And if you cut interest rates and mortgage rates fall, what is that going to do to the housing market? Because housing is one of the biggest factors in inflation. And if mortgage rates fall substantially enough, because the Fed says they're going to continue cutting rates through 2024, they want to cut rates even more in 2025, and maybe even more in 2026. So if the Federal Reserve Bank continues cutting interest rates, mortgage rates continue to fall, will that create an excess amount of demand in the mortgage market? Because if we think about this hypothetically, let's just say mortgage rates fall to 5%. What would that do? Well, there's a lot of dormant home buyers that are sitting out there saying, or who have said, I don't want to buy a home because it's too expensive, I can't afford the mortgage prices. But maybe some of them will say, I can afford a mortgage at 6% or 5%. And so if more people say, I can afford a mortgage at 5%, does that mean that more people are going to go and start making offers on homes? And if they do, does that mean we're going to start to see more bidding wars? And if they do, does that mean the home prices are going to start to shoot up even more? And if that happens, does that make the inflation problem worse? This is where we'll have to see. The Federal Reserve Bank says no. And of course, they're not stupid. I mean, they're made up of some of the smartest or supposedly smartest economists in the world. That's what they say. But that's something that you want to think about and something you want to pay attention to. Of course, many people said that inflation was not going to be transitory, but this is something you want to pay attention to see if the inflation problem reignites or what will happen, because what we've already seen happen as mortgage rates have fallen slightly over the last 30 days, refinancing has shot up. We've seen about 100% increase in mortgage refinancing over the last year. Why? Because as mortgage rates have fallen in anticipation of the Federal Reserve Bank cutting interest rates, people are tapping into this equity in their homes and they're pulling this cash out. That way they have more money to spend. So something I want you to think about, which brings us to part number 3. What does this interest rate cut mean for asset prices? Now, if we focus in on the stock market, I want to make sure that this is very clear. The stock market is not moving linear with the economy. The stock market moves based off of what people think is going to happen in the economy. And pretty much everybody on Wall Street anticipated a Federal Reserve Bank interest rate cut on September 18th. The Fed has been hinting about it. They've been talking about it for a while. So the Federal Reserve Bank cutting interest rates is not a surprise. And that had already been priced into the markets. So there's a saying on Wall Street that goes, buy the rumor, sell the news. And what that means is when you hear news of something happening, the markets already react to that. And then when the news happens, it's not as big of a deal as many people expect because it was already priced in. So when we think about what's going to happen for the stock market, I want you to take a step back and really look at this from a broader macroeconomic standpoint, which is, what is this going to do to the economy, and what will that then trickle down to in the stock market? Because trying to predict day-to-day swings in the stock market is impossible. No one knows what's going to happen tomorrow or next week or the month after that. But what we can do is understand how this will affect the economy, because while the stock market and the economy don't move linearly, over the long term, we do start to see more of a correlation between the stock market and the economy. So when you cut interest rates, the goal with this is to stimulate spending, and the goal is to make borrowing cheaper for businesses. That way businesses can grow bigger, and so they can borrow money cheaper. Now, of course, there's consequences with cutting interest rates, like with inflation and all of that. And there's consequences with businesses making dumb decisions, because now they can borrow money cheaper, and so they can make dumber investments. But that's not the focus of today. If businesses can borrow more money, they can spend more money, and they can hopefully grow faster, and hopefully it will stimulate more spending. That's the goal with cutting interest rates. But the risk that the Federal Reserve Bank has highlighted, along with many other economists, is that there's also a risk of an economic slowdown. That's why the Federal Reserve Bank is cutting rates so aggressively, because they want to prevent this recession that people are talking about. So this is where you want to start to play out these factors. That on one hand, lower interest rates are there to stimulate the economy. On the other hand, the Federal Reserve Bank is stimulating because they're worried about an economic slowdown. What does that mean? If we see an economic slowdown, that would eventually trickle down to the markets. But if we do stimulate the economy more than the economic slowdown, that can also trickle down into the markets. That's what you want to pay attention to when it comes to stocks. And that's why I want you to be a long-term investor as opposed to being a trader, because there are so many factors that can move the market. I mean, somebody could post a tweet tomorrow and that could move the markets. And that's why I want you to be a long-term investor as opposed to an emotional trader, by understanding what's happening, being financially educated, and paying attention to the financial trends. When it comes to the housing market, it's a little bit different, because housing is very sensitive to interest rates. When interest rates go down, more people can go out and borrow money and buy a home, which can then push home prices up because you have more buyers out there. So the question that everybody will want to see is, in the next 30 days, how much lower are mortgage rates going to go? And what is that going to do for mortgage applications? So you can pay attention to this. Of course, we'll be keeping you posted on market briefs. I'll be keeping you posted here as well. But if we start to see a real rise in mortgage applications, you can bet that you're going to see a rise in mortgage offers and bidding wars. And if that happens, that could push home prices higher, which could make home prices higher for people that own homes, which is good, but it could also make the inflation problem worse. So that's what I want you to pay attention to. And that's why I want you to be a holistic investor and understand what's happening. Of course, again, we'll be keeping you posted on market briefs. And with that, I will see you on YouTube tomorrow.